So founders love a good write-off. You spend money on your business, your CPA tells you that the expense is deductible, and that deduction helps you lower your taxable income. Look, that's extremely valuable and all businesses do this. But then someone mentions the R&D tax credit, and that's where usually the conversation gets a little bit confusing. A lot of founders assume that the credit is just another name for a write-off. Others assume that they have to choose between deducting their research expenses or claiming the credit. So neither one is quite right. So what I want to do over the next few minutes is explain in very simple terms what a write-off actually does and what a credit does and how the two can work together when your company is performing qualified research. Because look, the real opportunity with the R&D tax credit is not that it replaces your normal deduction. It can provide an additional benefit on top of the deductions your company is already taking. So that's one part that I want to make super clear in the very beginning. So let's go ahead and start with the write-off, because that's the term that most founders, CEOs, or executive teams already know. When someone says write-off, they are talking about a tax deduction. Your company earns revenue. It also spends money operating and growing the business. Those are legitimate business expenses that reduce the amount of income that is subject to tax. It reduces your taxable income. It does not directly reduce your tax bill dollar for dollar. Instead, it reduces the number used to calculate your tax liability. Let's take a very simple example and walk this through step by step. Say your company earns $200. It also has $100 of deductible business expenses. You start with the $200 of income, subtract the $100 of deduction, and you are left with $100 of taxable income. Think of this kind of equivalent as profit. That's the same math that you're already going to use when you think about your business. Revenue minus expenses equals profit. The tax language just, changes some of the words slightly. You have gross income minus deductions equals taxable income. That's going to be your equivalent. So it is essentially the same calculation wearing just a little bit of a different suit. Let's assume, just for this example, that the company is a C corporation subject to a 21% federal corporate tax rate. The government applies that 21% tax rate to the company's $100 of taxable income. Remember, that's the profit that we just calculated. Once you apply that, it produces a $21 of federal income tax liability. What did that $100 of deduction really do? Right? So without that deduction, the company would have had $200 of taxable income. At a 21% rate, that would have produced a $42 of federal income tax liability. With that deduction, the company has $100 of taxable income and a $21 of federal income tax rate. That $100 of deduction, basically it saved the company $21 of federal tax. That is how a deduction works. The deduction, again, is an extremely valuable thing to do, but the company did not receive a $100 back just because it had a $100 write-off. It received a tax benefit associated with that deduction. For this C corporation, that federal benefit was approximately 21%. And I want to pause and make this extremely clear. That 21% rate is specific to C corporations in this very simple example. There are other what we call pass-through entities such as S corporations or partnerships, or say you have individual owners and additional state taxes and other limitations also as well. But look, the basic idea remains the same. The write-off reduces the income that gets taxed. It does not reduce the final tax bill dollar for dollar. If this already feels different than the way that you have been thinking about write-offs, look, that's completely understandable. Most people hear $100 write-off and understandably picture $100 is coming back. There's a link below if you would like to talk through this in a little bit more detail and talk through maybe your company's R&D spending and how it's currently being treated. But first, let's continue and talk a little bit about the credit side. A tax credit works further down the calculation. So a deduction comes into the calculation before the company's tax is determined. The credit comes in after the tax has already been calculated. So let's go back to the example that we were using already. The company earned $200 of income. They deducted the $100 of expenses and ended up with $100 of taxable income, or say profit. At the 21% C corporation rate, that produced a $21 federal tax bill, $100 times 21%. Now, let's assume that after running the company's qualified research expenses through the R&D credit calculation, the company generated, for example, $10 of federal R&D tax credit. That $10 of credit does not reduce the company's taxable income. That reduces the actual tax bill dollar for dollar. The company starts with the $21 of federal tax liability and it applies the $10 of credit, and what's left is $11 of federal tax. So that is the big difference that we're talking about here. The deduction helped determine how much income was taxable, then the credit then reduced the tax calculated on that income. An easy way to picture this is to think about maybe you're checking out at the store, right? So your deductions help reduce the amount of merchandise sitting on the cart before the bill is totaled. Credit is more like store credit or maybe those coupons that you apply at the register after the final bill has been calculated. Both are extremely valuable. They just come into the calculation at different times and perform different jobs. The sentence I want you to remember is a write-off reduces the income that you are taxed on, and a credit reduces the tax you actually owe. So this is why $1 of tax credit is generally more valuable than $1 of deduction. So $1 of deduction saves you a fraction of a dollar based on your applicable tax rate. $1 of usable credit generally reduces your tax dollar for dollar. But look, that doesn't mean that deductions are weak or useless in any way. You should still claim every legitimate deduction available to your company. The point is simply that a deduction and a credit should not be confused with one another because they do two very different jobs. Now we get to the part that I think matters most for a lot of founders and CFOs that are thinking about this. You may be listening to this and thinking, hey, look, Chris, okay, look, I get it. The credit sounds more valuable. Does that mean that I should give up the deduction and take the credit instead? This is a big misunderstanding that I want to address right away. Generally, no. The R&D credit is not normally a replacement for deducting the company's research expenditures. Your company may still receive the tax benefit from its deductible research costs and also on top of it generate an R&D tax credit based on qualifying portions of that spend. Imagine your software company pays engineers to improve its platform. Those wages may already be included in the company's normal payroll expenses and deductions. If portions of those wages also meet the R&D tax credit requirements, the company may be able to also use those same underlying activities and inputs in calculating an additional tax credit. The deduction and the credit, look, they're related and they're interconnected, but they are doing two very different things. The deduction reduces your taxable income. The credit provides an additional reduction against the tax liability, again, assuming your company currently uses it. That's what makes the credit so meaningful and valuable. You are not necessarily being asked to give up a deduction you are already entitled to take. You are looking at whether the same qualified research activity may also produce an additional credit benefit. There's a technical coordination rule that I do want to make sure that I mention. The tax law does not allow a company to receive an unrestricted double tax benefit on the exact same dollars. So when the company claims the research credit, the tax return generally needs to coordinate the tax credit with the related deductions. So that is often handled in one of two ways. The company may reduce the related deduction by the amount of the credit, or it may make an election to claim a slightly reduced research credit instead. Your CPA handles that technical calculation on the return, but I do not want that detail to cloud the bigger point that we're trying to make in this video. Even after that coordination, the company can still receive the deduction benefit and an additional credit benefit. So it's not simply, would you rather have the write-off or the credit? I want you to ask the better question, and that question is, are we taking our proper deductions, and have we also checked whether our research activities generate an additional credit? That's an extremely valuable conversation and question to ask with your tax team. If your company's already deducting software development, maybe engineering, product development, and technical payroll costs, but no one has ever separately reviewed those activities for the R&D tax credit, this is a gap that I would definitely look into. You can absolutely raise that question with your existing CPA or tax advisor, but if you'd like to talk it over, look, there's a link below if you'd like to check it out, and we can definitely talk through the details and see if there's a meaningful credit opportunity. But let's keep going because there's one more reason founders tend to overlook and confuse this area quite a bit. The deduction is usually really easy to see. The company pays an engineer $150,000. The wage goes through payroll, right? It appears in the financial statements. The expense reaches the tax return. That normal accounting process is already built into the business. But the R&D tax credit process requires a separate analysis. Someone has to ask whether that engineer really worked on qualifying work. Were they developing or improving specific product process or maybe a technical capability? Were there technical issues and uncertainty involved? Did the team evaluate different designs, methods, maybe architectures, and different approaches? Was the work performed in the United States? How much of that person's time related to qualified activities rather than, say, maintenance or break fix things? The payroll expense may be obvious, but the credit oftentimes is not obvious. This is why a company can take the deduction every year and still completely miss on the R&D credit. The CPA may have correctly deducted the company payroll and the development expenses, so nothing was necessarily done wrong on that side, but unless someone separately asked the question on the R&D tax credit side, that opportunity may never have been identified or found in the first place. This is especially common with software companies because founders don't always ask that much or maybe think of their development work as R&D work. They think of it as we're just building a product. They are dealing with integrations, performance problems, scalability, architecture issues, data processing, technical limitations, all of the above. To them, that's just simply the work, but portions of that work may also meet the tax definition of qualified R&D. So that doesn't mean that every engineer's wage qualifies or anything like that. It doesn't mean that every project also qualifies as well. And finally, it doesn't mean that the company automatically receives a credit simply because it's a technical team. Look, the work still has to meet the qualification requirements and the company needs to support the costs included in the calculation, but it does mean that the company should be asking these questions separately. Taking the deduction does not answer whether the company qualifies for the credit. There's one more question that founders typically ask right about this point. Chris, all this stuff is great and all, but what good is a credit if we're not profitable and we don't even owe any income tax? And look, that's an extremely fair question and I get it. For a profitable company, the credit may reduce the federal income tax it currently owes. But say for an eligible qualified small business or a startup, the company may be able to elect to use that R&D credit against certain payroll taxes. So if neither of these options is available, you can still generate that credit and it can be carried forward to use in a future year. So the credit may still have value even when the company is not currently owing federal income tax. The timing, the method, and the use of it really depends on the company's specific fact pattern. None of this takes away from the company's normal business deductions. The deduction and credit continue to sit on separate lanes and work in different ways. One affects taxable income and the other affects the tax liability or even eligible to offset some payroll taxes. Look, this is why this conversation should just be part of the company's annual tax planning conversations rather than something reviewed only after the company has become profitable. So let's bring the whole thing back to the simple numbers again. A company earns $200 of income, it has $100 of deductible expenses, write-offs, things of that nature, and then that deduction reduces your taxable income to $100 or your profit. At a 21C corporation tax rate, the company calculates a $21 of federal income tax liability. Then assume that the company separately generates a $10 R&D tax credit. Subject to the technical coordination rules we talked about, the credit provides an additional benefit against that tax liability. That's really the full picture that we're talking about here. The deduction did not disappear because the company claimed the credit, and the credit was not simply another name for the deduction, but they both did very different jobs and they both provided value in their own ways. So instead of asking, should I take the write-off or the deduction or the credit, ask, are we taking the correct deductions, and also are we also capturing any credit available from the qualified research activity that we are performing? If you are paying US-based employees, contractors, or building or improving software and technology, it's worth checking the math on both sides of the equation. Make sure the company is receiving its proper deductions, then separately determine whether any of those activities generate an R&D tax credit. You can work through that with your CPA or your finance team and always get your tax advisor involved. If you want to talk this through, I'm more than happy to do that. There's a link below in the description and we're more than happy to talk through your specific fact pattern. Okay, a quick and important note right before we wrap. Everything I covered here is educational based on how the tax rules generally work. Every company's situation is different and the final treatment depends on its specific activities, entity type, tax position, and filing facts. This is not individual tax advice, so please review your company's situation with your own tax advisor. I appreciate you watching, and I'll see you in the next one.